You've probably heard the pitch by now. The Carolinas are still safe, affordable homes, steady jobs, friendly weather, and just enough growth to feel exciting without feeling risky. On paper, it looks like the last untouched corner of the American housing dream. But that image is starting to crack, quietly and unevenly, in ways national averages refuse to show. This isn't a sudden crash or a dramatic collapse. It's a slow fracture. Homes that once sold in days now wait. Prices don't fall loudly, they stall. Buyers hesitate, sellers hold on. And the people who feel it first are always the same ones. Those who bought late, stretched their budgets, and trusted yesterday's math to still work today. That's why this matters. Not to scare you, but to sharpen your awareness. Some cities look fine until you slow down and look closer. Subscribe and hit the bell early. Now you've been trained to look for crashes the wrong way. Big headlines, sudden drops. A moment where everyone agrees something broke. Housing almost never fails like that. It fails quietly, through misalignment, long before prices visibly fall. That's why people feel blindsided later, even though the warning signs were there the entire time. The first crack is affordability compression. Prices rise faster than incomes, but demand doesn't vanish immediately. Buyers stretch. Savings thin out. Monthly payments swallow flexibility. The market still moves, but only because people are overreaching. Once rates rise or costs tick up slightly, that fragile demand pulls back all at once. Not dramatically, just decisively. Next comes ownership cost stacking. A mortgage is never the full cost. Insurance climbs. Property taxes reset higher. HOA fees creep upward. Maintenance gets more expensive. Each cost alone feels tolerable. Together, they quietly push the next buyer out of qualification. Listings don't crash in response, they just stop moving. Then there's inventory absorption, which is often misunderstood. Markets don't need massive oversupply to weaken. They only need listings to appear faster than qualified buyers can absorb them. Homes sit longer. Sellers offer incentives. Price cuts follow patterns, not panic. Once buyers sense options, urgency disappears. That's when psychology flips. During booms, buyers fear missing out. During breakdowns, they fear being stuck. That single shift changes everything. People stop asking how fast they need to act and start asking how safe it is to wait. When waiting feels rational, momentum dies. This is why national averages are so misleading right now. They smooth over stress instead of revealing it. One neighborhood can freeze while another still sells, and the average pretends nothing changed. But housing is lived locally, not nationally. The danger isn't the headline number. It's the gap between asking prices and what real buyers are willing and able to pay. When that gap widens, deals fall apart quietly. Appraisals come in low. Financing gets tighter. Contracts get canceled. None of that looks dramatic, but all of it reshapes the market underneath your feet. By the time prices respond, leverage has already shifted, and buyers know it deep down. None of this requires fear. Markets don't need panic to break. They only need prices, costs, incomes, and behavior to stop moving together. Once you see this pattern, you stop reacting emotionally and start diagnosing structure. If you want to understand risk before headlines do, hit the bell now. Nothing here looks broken yet, and that's exactly why these markets are dangerous. They still sell, people still move in, coffee shops stay busy, schools stay full, and listings don't scream distress. But underneath that surface calm, the math has already shifted, and once that happens, housing markets don't recover quietly or quickly. Number 10 is Gastonia, North Carolina. On paper, it still looks like progress. Revitalized mill buildings, new subdivisions, and the promise of being a more affordable alternative to Charlotte carried prices higher during the boom. In 2026, that promise is under strain. Homes are sitting longer, not because they're undesirable, but because fewer buyers can qualify at today's payments. Sellers now offer closing cost assistance, rate buydowns, and incentives that would have been unnecessary a few years ago. Local wages never matched Charlotte-level pricing, and rising taxes tied to peak valuations are squeezing longtime residents. Buyers sense the mismatch. They don't rush. They hesitate, and that hesitation quietly resets expectations across entire neighborhoods. Number 9 is Spartanburg, South Carolina. And this is where excess supply meets fading urgency. From the highway, it looks like a success story. New roads, new neighborhoods, and steady development suggest momentum. The issue is pace. Builders added homes faster than demand could absorb once interest rates rose. Inventory here isn't catastrophic, but it's concentrated. Too many similar homes are competing for the same shrinking pool of qualified buyers. Sales centers rely heavily on incentives to keep deals together. Resale listings linger just long enough to shift buyer psychology. When buyers realize they're no longer forced to act immediately, behavior changes. They negotiate harder, compare more options, or step back entirely. That's not a crash. It's a stall, and stalls tend to last. Spartanburg also shows early signs of investor fatigue. Investors who once accepted thin margins now face rising insurance, maintenance, and financing costs. Rental demand hasn't disappeared, but renters have leverage. Vacancies last longer. Concessions creep in. Cash flow tightens. Some investors begin exiting quietly, listing properties not out of fear, but out of realism. Enough quiet exits can change pricing expectations block by block without ever making headlines. Number 8 is Rock Hill, South Carolina, and this market reveals how dependent alternative cities are on nearby job centers. For years, Rock Hill benefited from Charlotte's growth. More space, lower prices, easier living. That narrative pushed values up quickly. In 2026, the cracks appear in subtle ways. Appraisals come in low. Contracts wobble. Homes go back on the market. Listings require multiple price reductions before attracting serious interest. Investors who bought starter homes as rentals face rising taxes and insurance while rent growth cools. When several similar homes hit the market at once, comparable prices slide quietly, resetting expectations for everyone nearby. What ties Gastonia, Spartanburg, and Rock Hill together isn't collapse. It's denial. Sellers still expect yesterday's demand. Buyers feel today's pressure. That gap creates friction. Homes don't disappear, but they don't move either. They linger, and every lingering listing teaches buyers patience. This phase is easy to dismiss because life feels normal. Markets don't turn when people panic. They turn when enough people hesitate. Once hesitation becomes common, leverage shifts permanently. Buyers stop stretching. Sellers lose control over timelines. Investors stop absorbing excess inventory. Middle-class buyers feel this first, often before charts confirm it. They're the ones running spreadsheets late at night, questioning whether stretching still makes sense. They notice when open houses are quieter, when agents sound less confident, when listings sit without explanation. They don't announce fear. They pause. That pause spreads. One household waits, then another, until waiting feels safer than acting. That's how momentum drains without noise. Nothing in these cities looks dramatic yet, and that's precisely the risk. These are early fracture markets, where confidence erodes before prices follow. Stay with us, because the pressure builds from here. The tone changes in these markets because the stress is no longer theoretical. You don't have to dig for spreadsheets or interpret subtle signals. You can see it in the listings, feel it in conversations, and hear it in how buyers and sellers talk past each other. This is the phase where urgency disappears, and once that happens, markets don't rebound quickly. They grind. Number 7 is Winston-Salem, North Carolina. This is the kind of city people point to when they say housing here should be stable. Established neighborhoods, medical and research employers, historic homes, a sense of permanence. That reputation is exactly why the slowdown feels unsettling. Listings are sitting longer than sellers expect, especially in the middle of the market that once moved effortlessly. Renovated homes that would have sparked immediate offers now linger, quietly accumulating days on market. Mortgage applications have thinned, which means fewer buyers are even entering the funnel. Sellers adjust language first, then price. Open to offers replaces firmness. Incentives appear where confidence once lived. Nothing is collapsing, but momentum has clearly broken, and broken momentum doesn't fix itself overnight. Winston-Salem also exposes a painful truth about affordability. Prices ran ahead of local wages during the boom, and now the gap is impossible to ignore. Buyers are doing the math with today's interest rates and deciding that waiting feels safer than stretching. When the middle tier freezes, everything behind it jams. Move-up buyers can't sell. Sellers can't move forward. The market slows not because people disappeared, but because confidence did. Number 6 is Columbia, South Carolina. And here the stress shows up as saturation. This market was sold as dependable, anchored by government, healthcare, and higher education. Stability, however, doesn't protect against too much supply. Investor-owned rentals are everywhere. Entire blocks carry "for rent" signs, many owned by the same groups that bought aggressively during the boom. Rent growth has stalled, and in some areas slipped. When rental math stops working, investors don't panic. They exit quietly. They list several homes at once. That changes the tone of a neighborhood fast. Inventory here isn't just rising, it's stacking. Buyers have options, and they know it. Deals now depend on seller-paid closing costs, repair credits, and mortgage rate buydowns that would have sounded absurd a few years ago. Even then, buyers walk away easily. Inspections kill deals. Appraisals come in tight. Pending sales drift lower, signaling weaker months ahead. Columbia shows how investor fatigue can tip a market from steady to sluggish without a single dramatic headline. Number 5 is Greensboro, North Carolina. And this is where the grind becomes unmistakable. The economy looks busy. Trucks move. Warehouses hum. On the surface, everything seems active. Housing, however, runs on confidence, and confidence here is thin. Many homeowners are locked into low mortgage rates and refuse to sell. That limits fresh inventory. Yet the homes that do hit the market don't move quickly either. Buyers approach every listing expecting a discount. Months of supply have quietly doubled compared to the tightest years of the boom. Price growth has stalled, and once inflation is considered, real values are already slipping. That matters because costs keep rising. Taxes, insurance, maintenance all move in one direction. Sellers test the market, fail to hit their number, then pull listings only to relist later at lower prices. Buyers notice. Higher-end homes sit especially long, chasing a shrinking pool of qualified buyers. Each price cut resets expectations for the next listing down the street. What connects these three cities is visibility. The stress isn't hidden anymore. Inventory builds. Reductions normalize. Incentives become routine. Investors stop absorbing excess supply. Buyers wait because waiting feels rational. That reversal is powerful. During the boom, hesitation felt dangerous. Now, urgency does. This is where fear shifts. It's no longer about missing out. It's about being stuck. Stuck with a payment that doesn't make sense. Stuck in a house that won't sell quickly. Stuck watching nearby listings adjust downward while you hold the same price. Social proof flips. Buyers talk to each other. They see the same homes sitting. They hear about concessions. Waiting becomes the smart move. Markets in this phase don't bounce. They compress. They grind lower through time, not shock. If this is changing how you see housing, subscribe now. The patterns only get clearer from here. This is the point where the conversation stops being gentle. These markets aren't just cooling because buyers paused or rates rose. They're colliding with limits that don't negotiate. Insurance, infrastructure, climate exposure, and economic concentration don't wait for sentiment to improve. They impose costs, whether buyers feel optimistic or not. This is where belief meets math, and math wins. Number 4 is Raleigh, North Carolina. For years, Raleigh was marketed as inevitable. Tech expansion, research parks, cranes in the skyline, migration that seemed endless. That narrative carried prices far ahead of local incomes, even for highly paid workers. Now the structure underneath is tightening. New construction inventory has piled up in pockets that assume demand would stay emotional. Builders are offering concessions quietly, not because they want to, but because absorption slowed. Buyers are calculating differently. They're asking what $500,000 actually buys when insurance, taxes, and interest reset higher. Raleigh isn't failing, but it's exposed. It depends heavily on continued in-migration and a narrow set of industries staying strong at the same time. When hiring slows or relocation packages shrink, demand thins quickly. That fragility matters more now than the city's reputation ever did. Number 3 is Charlotte, North Carolina, and this is where scale magnifies risk. Charlotte looks powerful from a distance. Banking, finance, constant development, a skyline that never seems to rest. But underneath, the housing market is being squeezed from multiple directions at once. On the rental side, thousands of new apartment units have come online, all competing for the same tenants. Rents are easing in key segments, and when renting becomes negotiable, the pressure to buy at stretched prices fades. On the ownership side, listings are sitting longer, especially in suburbs that saw heavy investor activity. Institutional buyers have slowed or reversed course. When they step back, a quiet but important source of demand disappears. Charlotte's risk isn't collapse, it's compression. A large market can absorb stress longer, but when it turns slowly and expensively. Owners carry high taxes, rising insurance, and interest costs while waiting for momentum that may not return quickly. Number 2 is Charleston, South Carolina, and this is where structural risk becomes impossible to ignore. Charleston's beauty sells itself, but beauty doesn't pay insurance premiums. Coastal exposure has pushed homeowners' insurance, wind coverage, and flood policies into uncomfortable territory. In some areas, combined premiums have doubled or worse, and the unpredictability is just as damaging as the cost. Buyers can qualify for a mortgage, then lose the deal once final insurance numbers arrive. Pending sales slip even while headline prices hold. That mismatch is a warning. A healthy market closes deals. It doesn't just list them. Add climate exposure, limited elevation, and infrastructure strain, and long-term ownership becomes a question of tolerance, not desire. Second home buyers are pulling back. Local workers are being priced out. Inventory in vulnerable zones is quietly rising as owners try to exit before the next renewal shock. What connects these cities is constraint. Raleigh depends on growth continuing smoothly. Charlotte depends on scale masking friction. Charleston depends on costs staying manageable in an environment where they're rising fast. None of these risks reverse quickly. You can't refinance away insurance instability. You can't wish climate exposure into irrelevance. You can't diversify an economy overnight. This is where the tone has to change. These markets may still function, but they demand respect. Buying here isn't about optimism anymore. It's about resilience. It's about asking whether the system supporting your home has margin left or whether it's already running tight. If you want to understand risk before it becomes obvious, hit the bell. Structural pressure doesn't explode. It grinds, and once it does, time becomes very expensive. Number 1 is Myrtle Beach, South Carolina, and this is where all the warning signs converge at once. Not loudly, not suddenly, but unmistakably. On the surface, it still looks like a vacation economy humming along, towers facing the ocean, short-term rentals advertised as passive income dreams. But underneath, the structure has weakened in every direction. Oversupply is the first crack. Condo buildings are filled with nearly identical units competing for the same shrinking pool of buyers. When one owner cuts price, the entire building reprices downward. That resets expectations instantly. Investors who bought late are discovering that liquidity vanishes fastest in markets built on sameness. You're not selling a home, you're selling one option among dozens. Then comes investor saturation. Myrtle Beach absorbed years of speculative buying driven by optimism and leverage. Many owners never planned to live here. They planned to exit. Now they're trying to do that at the same time. When investors rush for the door together, there is no floor price, only bids that keep getting lower. Insurance shock turns pressure into urgency. Coastal premiums have risen sharply, and condo associations are passing those costs through via higher dues and special assessments. Owners don't just face falling values, they face rising monthly obligations. That combination is lethal. Buyers hesitate, lenders scrutinize, deals collapse after inspections and final disclosures. Weekend user demand seals it. Local wages don't support the prices these units were pushed to during the boom. Tourism doesn't guarantee permanent demand. When rental income softens and vacancy rises, the math breaks completely. Cash flow disappears. Appreciation assumptions fail. What makes Myrtle Beach ground zero isn't drama, it's clarity. Every mechanism we discussed earlier is present here, stacked together, reinforcing each other. Oversupply feeds price cuts. Price cuts spook investors. Investor exits flood inventory. Insurance raises carrying costs. End users step back. None of this required a crash headline. It only required imbalance. This is the warning, not because this market is unique, but because it isn't. The same pattern exists elsewhere, just less concentrated. This could have been avoided with restraint, with realism, with respect for limits. Subscribe and hit the bell, because this won't be the last market to break this way. Paying attention now gives you leverage later, and leverage determines whether you adapt early or absorb losses that compound quietly while markets adjust without warning or mercy for unprepared homeowners everywhere. What the Carolinas reveal in 2026 isn't a regional fluke. It's a blueprint for how housing cycles actually unwind across the country. When you zoom out, the biggest mistake people make is trusting averages. National numbers smooth over pain. They hide stalled cities behind stronger ones and convince buyers and sellers that stability still exists everywhere. But housing doesn't move as one market anymore. It fractures, quietly, city by city, street by street. And by the time the averages catch up, decisions have already been locked in. That's why patience has become leverage. In previous cycles, waiting felt risky. You waited, prices ran away from you, and regret followed. In 2026, the opposite is true. Waiting reveals information. Listings sit longer, price reductions repeat, incentives appear. Sellers show their hand not through words, but through behavior. Patience isn't indecision anymore, it's data collection. It allows buyers to see which prices are real and which were based on momentum that no longer exists. Pricing realism is now the dividing line. Sellers who understand where the cycle is adjust early and preserve options. Sellers who cling to peak-era expectations don't protect value, they trap it. Every extra month on the market adds carrying costs and erodes negotiating power. The market doesn't reward stubbornness. It quietly works around it. Buyers notice when a listing lingers. They don't assume quality. They assume resistance. For buyers, the lesson is clarity over urgency. You're no longer competing with crowds. You're negotiating with timelines. The strongest position isn't rushing in at the first sign of a price cut. It's understanding total ownership cost, local demand, and how much supply exists behind the scenes. The goal isn't to time the exact bottom. It's to avoid becoming the liquidity someone else needs to exit. For sellers, the shift is psychological. The market is no longer carrying you upward. You're carrying the property yourself now. That doesn't mean selling is a mistake. It means strategy matters more than optimism. Understanding who your buyer actually is, what they can afford, and how much competition they have changes outcomes dramatically. Pricing correctly isn't surrender. It's control. For investors, the Carolinas offer a hard reminder. Appreciation-driven strategies are fragile when leverage and sentiment fade. Cash flow, replacement demand, and exit liquidity matter again. Markets built on tourism, migration surges, or speculative sameness unwind faster than people expect. Risk isn't eliminated by popularity. It's often concentrated there. The most important shift is identity. You're no longer a passive consumer of housing narratives. You're an observer. You watch how long homes sit. You notice incentives. You listen to silence where urgency used to be. You don't need predictions when behavior tells the story first. That awareness is the advantage most people never realize they're allowed to have. Use what you've seen here as a lens, not a verdict. Apply it to your own city. Are listings stacking? Are buyers hesitating? Are sellers adjusting or resisting? Those answers matter more than headlines. Share what you're seeing in the comments. Collective observation sharpens clarity. Subscribe and hit the bell, because early clarity is the advantage most people miss, and once you see the cycle clearly, you stop reacting late and start choosing from a position of strength instead.